Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 5, 2026. Today, we are watching a stock market that is having just a complete identity crisis. I mean, on one side of the ledger, you've got companies building the physical infrastructure for artificial intelligence, right? And they're seeing their revenue double overnight. They're minting new trillion-dollar valuations and driving all the major indices higher. But then you zoom out from those server racks, and the everyday consumers who are supposed to eventually, buy the end products of all this technology, they are completely tapped out.
Yeah, they really are.
Right. And it's forcing massive layoffs and production cuts in legacy sectors. So welcome to today's deep dive. Our mission today is unpacking the daily market briefing for Tuesday, May 5, 2026, and really just figuring out how a market can pull so violently in two opposing directions at the exact same time.
Well, I think that tension is really the defining characteristic of this economy right now. We're looking at a hyper-concentrated capital cycle, because if you evaluate the session purely on the top-line numbers, it projects absolute stability.
Right. The indexes looked great today.
Exactly. I mean, the S&P 500 gained 0.9%, the Dow Jones climbed 0.7%, and the Nasdaq led the pack with a 1.1% increase. But, those aggregated figures are a veil. They completely mask a violent reallocation of capital where institutional money is just, they're abandoning traditional consumer goods.
It's totally rotating out.
Yeah, and pouring entirely into the foundational hardware required to keep the AI revolution moving.
Which is a staggering reallocation when you look at the specific semiconductor and hardware companies that are dominating today's activity. Like, let's look at AMD. They just topped their first quarter estimates, and the sheer force behind that beat was a 57% jump in data center revenue.
That's a massive jump.
It's unbelievable. We aren't talking about a nimble startup here. This is a massive legacy chipmaker growing its enterprise division by more than half in a single year. Investors are rushing in because they're realizing this infrastructure build-out is nowhere near its peak.
No, not at all. And a 57% jump at AMD scale, that represents a fundamental rewiring of global corporate budgets. What that number tells you is that Fortune 500 companies are deferring maintenance on older systems, they're halting stock buybacks, and they are aggressively funneling every available dollar into securing compute power.
Because it's an arms race.
Exactly. They view AI not as a neat little feature, but as an existential arms race. If they do not secure the physical chips right now, they risk permanent obsolescence.
Which perfectly explains the frenzy around Supermicro today. I mean, they were the top gainer of the entire session. The stock skyrocketed 19% on a massive guidance beat simply because their revenue more than doubled.
And doubled expectations, really.
Right. And what stood out to me in the briefing is that they are explicitly pointing to major progress in their U.S. manufacturing capabilities as a driver for this growth. It feels like, securing domestic supply chains is becoming almost as valuable as the technology itself.
Oh, absolutely. Domestic manufacturing is a massive structural moat right now. Historically, if you look at the semiconductor and server assembly supply chain, it has been precariously concentrated in East Asia.
Right, which makes investors nervous.
Very nervous.
Yeah.
So by proving they can scale complex server rack manufacturing within the United States, Supermicro is offering enterprise clients something almost as valuable as raw processing power. They're offering geopolitical security.
Oh, wow. Yeah, that makes sense.
I mean, think about it. When a client is spending $1 billion on a new data center, they need guarantees that a trade dispute or a regional conflict won't delay their hardware delivery by 12 months.
Right. You can't have your billion-dollar facility sitting empty because a cargo ship got rerouted.
Precisely.
And speaking of essential hardware, there's Micron, which just zoomed past a $700 billion market cap today. It makes it one of the most valuable tech companies in the U.S. And their major catalyst today is the announcement of a massive 245 terabyte solid-state drive built specifically for data centers.
Yeah, that drive is an engineering marvel.
It's insane. And it reminds me of the aerospace industry, right? It's like watching companies try to build a fleet of supersonic jets, but realizing only 3 companies in the entire world know how to forge the specific titanium required for the engines. Investors aren't buying the airline. They're buying the titanium forge.
That aerospace analogy captures the bottleneck perfectly. And to understand why a single 245 terabyte SSD moves a $700 billion needle, we really have to look at the mechanics of generative AI.
Okay, break that down for us.
So there's this common misconception that AI is purely about processing speed, like, the GPUs acting as the brain. But an AI model is only as smart as the training data it can actually access.
Right, need something to think about.
Exactly. These models require massive, persistent storage to hold exabytes of training parameters, text, video, and weights. So the SSD acts as the library. The GPUs act as the brain reading the books.
Okay, I like that.
And as multimodal AI models expand to generate, say, high-definition video and complex physics simulations, the sheer physical volume of data requires high-density storage solutions that simply didn't exist 3 years ago. Micron is filling that exact vacuum.
And it's not just Micron and AMD having a big day. Intel is poised to break major milestones, too. They rose 14% today as options traders just flocked to the stock. In fact, Intel, Microsoft, and Apple were the most active stocks of the entire day.
It's all part of the same hypercycle.
It is. But here's the catch, and this is where the briefing gets really interesting. That enterprise AI budget is basically the only thing keeping these tech giants afloat right now. Because outside of those data centers, the reality is incredibly bleak.
Yeah, the consumer side is a completely different story.
A completely different universe. I mean, Lucid Group ended the day as a top loser alongside Spirit Airlines. Lucid is planning to aggressively adjust its production downward, and they're citing elevated vehicle inventories. Basically, they need to align production with actual customer demand for their luxury all-electric vehicles. They literally have lots full of six-figure cars and no one to buy them.
Well, the mechanics of consumer finance are just brutal right now. An enterprise buying a data center amortizes that cost over a decade, right? They're banking on massive efficiency gains and a high return on investment.
So it pays for itself.
Exactly. But a consumer buying a luxury EV, they are financing a depreciating asset in an environment where the cost of living and borrowing costs in general have severely eroded their purchasing power.
Right, your mortgage is up, your groceries are up.
Yeah, so Lucid is hitting the wall of discretionary spending limits. When household budgets tighten, the $100,000 electric vehicle is the absolute first thing cut from the list.
And we see that same discretionary wall hitting Microsoft, which is fascinating because, like we said, they were one of the most active stocks today overall due to their AI dominance, but internally, the CEO of Xbox is completely overhauling leadership amid sinking console sales. He explicitly stated the company needs to fundamentally evolve how it works.
It's a tale of two divisions.
It really is. Microsoft is the perfect microcosm of this bifurcated economy. Their cloud and AI divisions are minting billions, while their legacy consumer gaming division is undergoing really painful restructuring because gamers are just tapped out.
And that internal divergence at Microsoft really illustrates the core issue with the broader index numbers we discussed at the start of the deep dive.
How so?
Well, the Nasdaq being up 1.1% implies universal health. But inside these mega-cap companies, there is a fierce cannibalization happening. Consumer divisions are being starved of resources to feed the capital-intensive AI divisions. The velocity of money has shifted completely from the retail checkout counter to the corporate procurement office.
Well, that's a great way to put it. But fulfilling those massive corporate procurement orders requires physical materials, right? And suddenly, the global supply chain is refusing to cooperate. The briefing highlights real-world geopolitical tensions that are threatening to bottleneck this exact hardware boom.
The macro headwinds are very real.
Yeah. Like, we are seeing federal data showing hiring activity actually increased in March, which normally signals economic strength. But the ongoing Iran war is threatening to stall this progress entirely, creating massive risks for global trade routes.
Right, because when a conflict involves a major energy-producing region like Iran, the ripple effects through global logistics are instantaneous. It isn't just about the localized violence, as tragic as that is. It's about the rerouting of cargo ships. It's the dramatic spikes in maritime insurance premiums.
Oh, sure.
And crucially for tech, it's the delay of critical components moving from assembly lines in Asia to data centers in Texas. So that hiring data from March reflects domestic optimism, but that optimism cannot survive a prolonged disruption in global shipping.
And it isn't just shipping costs either. The actual raw materials are skyrocketing. Like, aluminum prices are surging right now, which is creating severe cost pressures for these large companies. And, when we talk about AI, we usually talk about silicon and code. We don't think about metal.
No, people picture the software.
Right. But building a hyperscale data center requires thousands of tons of aluminum. You need it for the server racks, the structural supports, and especially the massive liquid cooling systems required to keep these dense GPU clusters from just melting down.
Exactly. Aluminum is literally the scaffolding of the artificial intelligence boom.
Wow.
And the profit margins that AMD and Supermicro are currently celebrating, those are highly sensitive to the cost of these base metals.
Hmm.
If aluminum prices remain elevated due to energy costs, because, smelting aluminum is incredibly energy intensive, those hardware companies have to make a tough choice.
They either eat the cost or pass it on.
Right. They either absorb the cost and watch their margins compress, or they pass the cost onto the enterprise buyers. And if they do that, it raises the barrier to entry for AI adoption across the board.
So when aluminum spikes and cargo insurance skyrockets due to the Iran conflict, it naturally forces a capital rotation. I am seeing in the briefing that because of all this uncertainty, institutional money is eyeing the energy sector for increased investment right now. They're specifically targeting Chevron and Occidental Petroleum.
It makes perfect sense.
Right. It seems like investors look at the fragile, globally extended supply chains of the tech sector, and they hedge that risk by pouring capital into domestic, tangible energy production.
Yeah, that rotation into Chevron and Occidental is a classic preservation mechanic. During periods of geopolitical stress, especially those threatening Middle Eastern oil output, the premium on domestic energy production surges.
Because it's safe.
Because it's safe and because of how they're valued. Tech stocks are valued based on their future earnings potential, sometimes 10 or 20 years out. Energy stocks, on the other hand, are valued based on the cash they are generating right this second. So when the future becomes uncertain due to war, capital flees the speculative future and anchors itself to the profitable present.
That makes total sense. And, when the macroeconomic landscape gets this turbulent, markets instinctively look to Washington for stability. They look to the Federal Reserve to manipulate the levers of the economy or regulatory bodies to enforce the rules. But today's news reveals that Washington is actually introducing its own layer of profound structural volatility.
They certainly are.
Let's start with the Fed. Federal Reserve Chair Jerome Powell announced plans to remain a member of the Federal Reserve Board even after his term as chair expires this month.
Yeah, which is a significant departure from modern historical precedent. Typically, when a Federal Reserve Chair's term at the helm concludes, they resign from the Board of Governors entirely.
Just to get out of the way.
Basically, yeah, to give their successor a clean slate. So Powell choosing to stay on the board means his specific economic philosophy and his voting power on the Federal Open Market Committee will continue to directly influence monetary policy.
And this move is already causing friction on Capitol Hill. Senator Tim Scott strongly criticized the decision today, calling it a, quote, significant mistake.
And the underlying tension here seems to be about the trajectory of interest rates. Right.
Undoubtedly.
If Powell, who has obviously steered the recent restrictive monetary policy to fight inflation, remains a voting member, it signals to the market that the era of higher borrowing costs might be locked in for much longer than anticipated.
And the cost of capital is the invisible gravity acting on everything we have discussed today.
How so? Connect those dots for us.
Well, if Powell's continued present signals sustain high interest rates, it drastically impacts the valuation models for every tech company on the Nasdaq. Building that billion-dollar AI data center we talked about requires taking on massive corporate debt.
Right. You don't pay cash for that. Exactly. And if the interest on that debt remains elevated, the return on investment for generative AI has to be even higher to justify the capital expenditure. So Senator Scott's criticism highlights the political anxiety surrounding a prolonged restrictive monetary environment.
So the Fed is signaling continuity in its hawkish stance. But meanwhile, the Trump administration is proposing an absolute regulatory earthquake regarding how companies actually report their financial health. The SEC is formally proposing a rule change to end mandatory quarterly earnings reports.
Which is huge.
It's massive. They want to allow companies to file semi-annual reports instead. So public companies would only have to open their books to investors twice a year instead of 4 times.
Yeah.
I mean, wait, shifting to semi-annual reports, that's like a teacher deciding you only get a report card twice a year instead of 4 times.
It's a dramatic shift in visibility.
Yeah. In a market where a single quarterly guidance beat just sent Supermicro up 19%, isn't flying blind for 6 months incredibly risky for investors?
Well, removing the quarterly reporting requirement would certainly dismantle the primary price discovery mechanism of modern financial markets. I mean, since the 1930s, the rhythm of Wall Street has been dictated by the 3-month earnings cycle. It forces corporate executives to regularly verify their financial narratives with hard, audited data.
Right. It's the only thing anchoring these massive tech valuations to reality right now. If the SEC switches to semi-annual reporting, we are effectively removing the market's primary reality check for 6 months at a time. The argument I always hear for this, though, is that it frees CEOs from short-termism,
Yes, that's the main defense.
like that they won't have to sacrifice long-term R&D just to hit an arbitrary 90-day profit target to appease the algorithms.
And that is a valid administrative argument. Proponents suggest that in industries like semiconductor manufacturing, where building a new foundry takes 5 years, forcing a CEO to justify expenditures every 90 days is completely counterproductive.
Okay, fair point.
By extending the reporting window to 6 months, companies could execute long-term strategic visions without the constant threat of a stock sell-off due to a slight quarterly revenue miss. Plus, it dramatically reduces the millions of dollars spent annually on compliance and auditing.
Sure, that makes sense for the executives in the boardroom. But for the institutional investor or, the retail trader managing a retirement account, the periods in between those semi-annual reports become incredibly dangerous.
You're losing a lot of data points.
Exactly. Market efficiency relies on the continuous flow of verified data. Without quarterly guidance, the options market would have to price in massive, unpredictable volatility. Imagine if we didn't know about AMD's 57% jump in data center revenue today, and we just had to guess their performance based on rumors and supply chain leaks for another 3 months.
Well, the absence of verified data always breeds rampant speculation. If companies are only guiding the market twice a year, algorithmic trading models lose their calibration points. And the inevitable result is that when those semi-annual reports are finally released, the delta between market expectations and corporate reality could be massive.
Oh, the swings would be violent.
Historically violent swings in stock prices on reporting days, yeah,
Right.
because you'd have 6 months of pent-up speculation colliding with actual balance sheets all at once.
Wow, the whiplash across today's briefing is really intense. I mean, we are tracking a market being propped up by an unprecedented hypercycle in AI hardware, with companies like Micron and Supermicro building the literal scaffolding of the future. But that same market is being weighed down by a tapped-out consumer base, global supply chains fracturing under the pressure of the Iran conflict, surging raw material costs.
And a Washington establishment that might fundamentally alter both interest rate trajectories and how we measure corporate health. And all of these elements are deeply interconnected. The surging cost of aluminum impacts the margins of the AI hardware build-out. The restrictive interest rates, signaled by Powell's extended tenure, dictate whether consumers can afford Lucid's vehicles or whether tech giants can finance their data centers.
It's a domino effect.
It really is. And hovering above it all is the potential that the SEC might turn the lights off on financial transparency for 6 months at a time.
Which makes interpreting the headline index numbers more treacherous than ever. Because if you just saw the Nasdaq up 1.1% today, you would assume smooth sailing, and you'd be completely missing the structural shifts happening beneath the surface.
Right. And this brings us to a vital question regarding the mechanics of market transparency going forward. If the SEC successfully cuts earnings reports down to twice a year, and artificial intelligence technology continues accelerating at this breakneck month-by-month pace, how will you evaluate the true health and risk profile of your investments during those long 6-month gaps in the dark?
That is the perfect puzzle to leave off on. When the velocity of innovation outpaces the frequency of regulation, navigating the market becomes an entirely different game. Keep questioning the headlines, keep looking for the physical mechanisms driving the numbers, and we'll be right here next time to help you unpack it all. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.